What's the best way to generate retirement income? Ask social media and you'll hear a handful of popular strategies. Advocates will paint a rosy picture and perhaps gloss over some potential pitfalls that could jeopardize your golden years. So, a veteran financial planner is here to give us the full story, the good, the bad, and how to keep things from getting ugly. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented to you by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I'm excited to bring you some popular retirement income strategies and put them under the microscope. Maybe it's the former journalist in me, but I gotta say, I love a good fact check. So let's get some thoughtful perspective from a seasoned pro. Joining us is Simon Wong, Head of Financial Planning at Blueprint Financial. He has over 15 years of experience helping Canadians plan their retirements. He's frequently quoted in the Globe and Mail, and he's also the author of the book Affluence, Wealth Planning Guide for Canadian Business Owners. Simon, it's wonderful to have you with us. Thanks for taking the time to chat.
Thank you very much, Robert. I appreciate coming on the show, and thank you for inviting me as well.
I got to say, Simon, you have a long list of letters after your name, sir, thanks to all these professional designations that you've racked up. I can barely find time for breakfast. How did you find time to rack up all these credentials in the financial industry?
Yeah, no, that's a great question. I've always had a big desire and also just an interest in learning. And, I'm quite passionate about this industry. And, honestly, it never really felt like I was doing a lot of work to learn this because it was just an interest that I took into. And as the years went by, I did one designation, then I did another designation. And each designation usually opens up more questions. And you're like, well, after the CFP, I'd like to learn a little bit more about estate planning. And after that, I wanted to learn a little bit more about insurance. Then I wanted to learn about investments. And it just kind of ended up being that I just took a lot of courses because I was interested in it, more or less. It was never a plan.
Well, at a certain point, your title is just going to run off the end of the page here, but it's fantastic to hear that you're so excited about this stuff. And of course, you've helped so many clients over the years map out their retirement finances here. What do you think is the single most important factor to creating a sound retirement plan, irrespective of what particular strategy that you choose?
Yeah, no, that's a really great and insightful question, Robert. Honestly, I think when it comes to creating a sound financial plan, it's really sitting down and understanding what the client's goals are, understanding what their concerns are, and really trying the best to both address, and achieve those goals, while at the same time address and try to mitigate against any of those concerns that may potentially come to light. I think, and today, even though we are talking about strategies, I always like to say that to a lot of our clients that, the strategy is one thing, but you really have to match strategies and you got to match what you're going to do to your actual goals. And there is no rule of thumbs when it comes to retirement and financial planning.
Right. Everybody has such a unique experience here, but the key takeaway here is, fit your life or the strategy rather to your life, not your life to the strategy. Right. You want to be keeping in mind all your unique needs here. Makes sense. I'm curious though. Do you find that there's a particular mistake or stumbling block that a lot of retirees tend to get into?
Yeah, I would say so. Yeah, I think one of the biggest mistakes that retirees sometimes make is they tend to focus in on maybe one strategy, or they tend to focus in on something they heard or something they read, and they use that strategy exclusively for their entire retirement. And like you just said, not everyone is in the same situation. Not everyone has the same goals. And unfortunately, what ends up happening is you may not live your retirement to your fullest. You may end up paying more taxes than you should. Or worse off, you may end up running out of money in retirement, which is every retiree's worst fear, essentially.
Do you find in your experience that people tend to run out of money if they're going to make a mistake, or do they not spend enough money? Because I see these surveys out there where Canadians think they need something crazy like $2+ million to retire comfortably here. What's your experience with that?
Yeah, it could be. Again, I don't want to speak for the entire population out there, but I would say in our client base, we tend to see that retirees underspend for the most part. I think that just comes from a sense of not understanding how much you can spend. They don't know what the particular future holds. They haven't, maybe they're concerned about inflation. They're concerned about maybe their investments aren't going to do as well, or maybe they've got some big goals in mind. And we've had clients that essentially kind of take a step back from maybe some of the hobbies they enjoy, like golf, because they feel like they're spending too much. And I think that if anything, I've seen most of our clients tend to underspend because they tend to be more conservative than overestimate how much they can spend.
Okay, well, let's talk about retirement strategies here, maybe some of the pros, but also some of the hidden risks that investors want to consider, like some of the ones you're talking about. Underspending, definitely a big one. I'm sure we'll get into that and more. So let's dive right in. For those in our audience, though, who want to get in on the conversation and maybe you have a question for Simon, make sure you submit them to us, okay? If you're watching on WebBroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, use the questions and comments box. And if you're watching on our YouTube live stream, click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your question. All right, Simon, let's get down to business here. The first retirement income strategy that we're going to chat about here is a classic one, the 4% rule. For those who aren't familiar, though, just tell us how it works at a high level.
Yeah, 4% rule is really interesting. It was made popular in the late 90s by the Trinity study. It essentially says you can invest your retirement savings in a balanced portfolio, stocks and bonds, and withdraw 4% of the starting value in the first year of retirement and every year after, adjusting that dollar amount for inflation every year after, and your money should last for the next 30 years until you pass.
Yeah, so the math behind it seems like pretty simple and stuff like that. Maybe paint us an example of like why you think it's so popular.
Yeah, it gives retirees a number. It's a really simple strategy to understand, and I think one of the biggest questions we typically get from retirees is how much can I spend in retirement and while I run out of money. And for example, if you have $1 million and the rule suggests that you can take out $40,000 a year, it's really simple, doesn't require a lot of complex calculations. And in addition to that, it also kind of gives a lot of people that are also saving for retirement a framework for how much they should be saving. Because again, if they know that they're going to want to spend about $40,000 a year in retirement at age 65, they know they're going to have to try to get to that 1 million mark. And it just makes it easier for them to visualize and save towards it because they have a goal and they know how much they can spend in retirement.
Yeah, and speaking of visualize, we had a chart there up on screen just showing how successful the 4% rule historically has been over a long period of time. We're talking a 99% hit rate here that you're going to make it through retirement without running out of money, which is a pretty compelling thing here. That said, what are some of the potential risks that the 4% rule poses to investors that they might need to consider? I wonder if maybe there's like a horror story or something like that you can paint for us too.
Yeah, for sure. So I would say one of the big things about the 4% rule is that even with that chart, it ignores individual situations, right? It doesn't take into account health costs, pensions, taxes, inflation. It doesn't even take into other things like sequence of return risk. If the markets suddenly drop in the first year of retirement, withdrawals can amplify losses and you could run out of money early. But I'll kind of go over a horror story of a client we started working with a few years ago. Prior to coming to us, he was following that 4% rule to the letter. Every year, he withdrew exactly 4% for his portfolio, adjusted for inflation, because he was terrified of running out of money. But again, it didn't take into account that, over the last few years, we've had quite low inflation. That didn't take into account that he also had a pension a quite healthy pension from an oil and gas company. So on paper, you know what? He was looking really financially secure. He just from even the level of feeling comfort, he's just like, I'm never going to run out of money. Things are looking really good. But the thing is, when we actually met him, he still couldn't shake that feeling, the fear of the markets, that the markets might collapse or that he might live far longer than expected. So, essentially for when he went into retirement in his early 60s, for the next 10 years until his early 70s, he lived far below his means. He skipped vacations he really wanted to take with his wife. He put off buying that nice car he really wanted. He even cut back on a few different hobbies like wine tasting and playing some golf because he felt like he didn't want to overspend because he was really sticking to that 4% rule, and he kept telling himself, better safe than sorry, right? And that's the first thing he kept telling me as well. But when we actually finally sat down a couple years ago, did that proper retirement plan and reviewed it when he was in his early 70s, we really discovered that his portfolio really had done incredibly well. Not only has his investments grown, but he was far ahead of where he actually started 10 years before that. So even after a couple of decades of withdrawals, he had more than enough to increase his lifestyle. And you know what? He did start spending more recently in his 70s, traveling a little bit more, treating himself for nice dinners, enjoying life. But he did admit something. He did admit to something that really stuck with me. He said, "My greatest regret isn't the money I saved; it's the 10 years I won't get back. I missed the healthiest years of retirement, right? Because he was too afraid to spend." And maybe that chart doesn't take into account that, because they're showing that, yes, people may not be running out of money, but at the same time, they may not be also maximizing their enjoyment of life in retirement.
Yeah, that's a really good point. Like, one thing on that chart that we had shown is that in the base case here, you pretty much ended up with the same amount of money that you started with, and it used $1 million as the base case here. That's a lot of money to leave on the table potentially. I mean, certainly you can pass some of it down, but what a shame to save and invest diligently all those years only to not take advantage of it. And if there's one thing you should never cut in retirement, it's your wine tasting club, okay? That's my golden rule right there. So with that in mind then, Simon, is there anything that you think somebody could do to potentially address some of those potential risks if they do decide to use the 4% rule?
Yeah, honestly, if there's people out there that are concerned about that and concerned about, really understanding and tailoring how much they can actually spend according to their lifestyle and their goals, is to, again, sit down with a professional, sit down with a retirement planner, a financial planner, look for someone that's a CFP, do some calculations and understand, what your actual drawdown rate is. Because like you just said, Roberts, a lot of people just ended up at the exact same place where they were when they started. They didn't draw down on capital, but again, what happens if you don't have any estate planning goals? What happens if you're not leaving any money for kids or family? Why not just enjoy that money for yourself, right? And maybe in even looking at it from another point of view, what happens if the kids are doing really well? They're doctors, they're lawyers, they're professionals, they're bankers, and they're doing financially well. Maybe they don't want the money and they'd rather you enjoy it.
Those are good kids if you have that problem here. That's a good one here. I actually want to throw something at you that I found really interesting. The creator of the 4% rule, Bill Bengen, recently came out and said, you know what, it's actually too conservative. 5% is more appropriate. What do you think about that, Simon? Should the 4% rule now be the 5% rule, generally speaking? Of course, it's just a rule of thumb, but do you think that's the new baseline?
Yeah, I mean, again, just looking at it from the perspective of, we've had, over the last decade, we've had exceptional rates of return on investments, and we've also had, minus the last few years, we've had exceptionally low inflation rate, right? So most people that have been following that 4% rule over the last few years, if they've been getting high, even on a balanced fund, they were getting potentially 7 to 10%, and the inflation was 1 to 2%. They've definitely been underspending for the last decade due to market factors. Mm-hmm.
All right, so something to keep in mind there. Let's move things along, though, to our second retirement income strategy that we're going to chat about here, and that's the RRSP meltdown. This is one that's very popular on YouTube. Everybody's searching this thing up. Take us through it. How does it work at a high level, Simon?
Yeah, it's a tax strategy, essentially, where you withdraw RSPs and simultaneously borrow to invest into a non-registered investment. The interest on the loan is tax deductible, so it offsets the tax you pay on the RSP withdrawal. And over time, essentially what ends up happening is you melt down an RSP without creating a large net tax bill. And hopefully what ends up happening is your non-registered investment kind of grows enough over that time period that you, instead of having RSPs to draw down from in the future, you have this non-registered investment to draw down from, which is significantly more tax efficient.
Okay, so I mean, tax efficiency, that sounds great, though, but what are some of the potential risks that somebody might want to keep in mind with the RRSP meltdown?
Yeah, again, depending on how large your RSP is, it involves leverage, which means that if your RSP is quite large, it could involve quite a bit of large leverage. And if markets fall, you still owe the loan. Cash flow can be tight as well. You have to service that interest on the loan. And again, CRA rules are quite strict around this. You don't want to take the CRA lightly. again, loan must be for investment purposes, and that just a capital property that's expected to generate income. And to some degree, it is complex, right? It's not suitable for most average retirees because there's a huge degree of risk that's involved. And a lot of people, even if it works on a piece of paper and the math makes sense, some people may not have the risk tolerance or may not have the psychological, I guess, resilience to deal with it. Because again, if you leverage out 500,000, let's say in 2020, you're planning on melting down your RSPs. We have a 40% drop in the market, and you lose over 200,000. And you're about 5 years away from retirement. That could be a huge amount of stress that an average person cannot manage, basically.
Yeah, that's probably the last thing that you want to be thinking of here in retirement, getting ready to just relax, and then all of a sudden you're glued to your computer monitor here, stressing out about whether you're going to be able to make the payments here and stuff like that. It sounds like there's a horror story somewhere in there, Simon, that you can talk to us about with the RRSP meltdown. Does anything spring to mind?
Yeah, no, for sure. We definitely saw a few of these type of clients, and it's not maybe one specific client, but around that March 2020 period where, the markets have been doing great. We've had record returns year after year for a number of years, since, and the last market crash was quite far away from most people's minds in 2008. And so we did have a few retirees come to us around that 2020 mark where, they did start, doing the RSP meltdown. They borrowed to invest in that 2019-18 period where markets were doing great. Everything's looking great. And even economists were saying, we're good for the next few years. COVID hits. No one expects it in March 2020. Non-registered investments, some of them, they may have cashed out a little bit early. They may have cashed out a little bit later. Some cashed out and lost 20%. Some lost 30%. While, the loan balance stayed the same. They panicked. They sold maybe not near the bottom, but unfortunately they locked in losses and they had a high amount of debt to still cover. And a lot of these people may still not be above water on some of those leveraged loans, unfortunately. And it goes to show you literally cannot time the market. And the best course of action a lot of times when the markets are going down is to essentially stay invested and to stay the course until the strategy is done. But like I said, the problem is not everyone necessarily has that resilience and ability to really really deal with that kind of stress when the markets fall that much.
Yeah, certainly retirees mostly are in the mindset of reducing their risk, reducing their volatility. So it kind of turns that on its head a little bit. Sure, the math might work out, but definitely something to keep in mind. You got to have the stomach for it, no doubt. What are some of the things that you think that somebody could do to reduce some of those potential risks if they did decide to pursue the RRSP meltdown?
Yeah, that's again a really great question. I would say, if anything, don't do it all one strategy, to be honest. I think some people, they tend to try to do too large of a leverage loan. They might have a $500,000 RSP. They calculate out that to completely melt down that RSP, they may need to take out, a $700,000, $800,000 leverage loan to offset the RSP withdrawal tax, and they want to offset it with the interest tax. But, again, the strategy would work just as well if you just have a small little loan that maybe you can manage. So I would say, don't get into the strategy unless you're willing to stomach the risk and stomach the ups and downs. But maybe just dip your feet into the strategy first and see how you feel about, a leverage strategy where you're only leveraging about 50 to 100 into the market versus a huge chunk. Because if you can't handle that $50,000 ups and downs on a $50,000 non-registered portfolio, you're definitely not going to be able to handle one over 500,000. So.
I want to ask you something too. Is there like a soft version of the RRSP meltdown that people could consider? Because I could see some retirees really being hesitant to take out a loan in their retirement years here. I have heard some people say if you just kind of prioritize drawing down the RSP early in retirement, you can kind of get a similar sort of effect. Would you say that's the case?
Yeah, no, there's definitely timing around RSP is a big part of financial planning and determining when the best possible time to draw down an RSP is. But again, it's really going to depend on client to client, because maybe that client has started their their pension plan at age 60, and maybe that they've got other taxable events that may happen around those ages, like they want to fix up their house, so they're going to take out a ton of money. They want to take a bunch of vacations when they're really young in their 60s, so they're already taking out money for that. So sometimes, again, when it comes to timing, it's going to be client to client, because if you're already incurring a lot of taxes on your investments, it may not make sense early on. But again, I think the biggest drawback or biggest risk of RSP is that deemed disposition when you pass, and I think it is a real concern, a real risk for a lot of retirees, because they don't want the CRA to hit them with that huge tax when they do pass.
Okay, fantastic stuff. Appreciate you walking us through that strategy there and some of the risks to consider. We got a lot more to get to here, but before we continue, I just want to throw out a quick programming note to our viewers here. Next week is the kickoff of Investor Education Month at TD Direct Investing. We're real excited about it. We're dedicating the entire month of October to helping new investors build their knowledge and confidence. So if you know somebody who would be interested, make sure to check it out. You can scan the QR code that we have on screen here. I believe we have a board that we can put up. We can also visit td.com/IEM to see the full schedule of live shows and interactive workshops that we have on tap here. Again, make sure to tell your friends and family who might need that extra encouragement to start investing, particularly if they're young, because the earlier you can start, the better, right? It's one of the things we know. Plus, of course, we have a fantastic contest on offer all month to help you get excited and maybe even pad your wallet a little bit. Let's check it out.
The Investor Education Contest, brought to you by TD Direct Investing, is officially live. Canadians can enter today for a chance to win a check for $7,000 and a 1-hour private educational session with a TD Direct Investing client education instructor. There are 3 ways to enter. Visit the TD Direct Investing Facebook page, click follow, then like the contest, post dated September 10th, 2025. Follow TD Direct Investing on Instagram and like the contest, post dated September 10th, 2025. Or attend a TD Direct Investing Investor Education Month workshop. Learn how to register at td.com/IEM. You can enter once using each method. The contest runs until October 31st, 2025. Scan the QR code for full contest rules and details.
Fantastic contest, and hey, $7,000 prize here. That's getting me excited too, so make sure to check that out. All right, Simon, let's continue along here the path. We got our third retirement income strategy that we're going to chat about. This is colloquially known as GIS Millionaire, the Guaranteed Income Supplement. How does this work at a high level?
Yeah, on a high level, how it works is, the GIS is essentially a monthly non-taxable benefit provided by the Canadian government to kind of low-income seniors who are already receiving OAS. And how it works is that, the GIS is, if you have some clever planning and you can allow people with substantial savings to essentially still qualify if you invest very heavily more into TFSAs versus RSPs or your pension, because obviously when you withdraw money from your TFSA, you are not getting tax on it. So, why it gets a lot of attention from, especially online, we see is that it feels like almost a loophole, right? How can a millionaire still qualify for low-income benefits? And the answer is really by controlling the type of income they show. And I think some people like this idea of being able to almost, in their head, or at least what they think is to get this free amount of money, sometimes up to maybe, I think GIS is up to about $1,000 a month is the highest possible one, so payout.
Yeah, so some people like it, but you are not amongst that group of people. Take us through why you think this strategy, generally speaking, isn't really worthwhile and the risks don't outweigh this potential benefit.
Well, I personally, we've talked about this, Robert. I personally don't like it because obviously you are taking advantage of someone that has quite a bit of money, taking advantage of a benefits program that is created for lower income individuals. Again, it really doesn't work if you've got large pensions, annuities, RSP withdrawals. It requires just such extreme precision in income planning. One mistake can kind of ruin the strategy. And there is like political and a government risk if they do end up closing those loopholes by, instead of just income testing it, they look at they asset test you as well. So there's so many different things that I just from my perspective that I don't think it would work out. And on top of that, there is opportunity cost of not investing in pensions and RSPs as well, which is what some people do, right, to try to achieve this strategy.
Yeah, I mean, things like the RRSP can be like a really powerful tool, as an example, to accelerate your wealth. So yeah, to leave those on the table just to maybe qualify for the GIS, which is, hey, it's, you know, it's money, but it's not a massive amount of money necessarily. Yeah, maybe the risk's not worth it, at least as you see it here. So then let's move on to our fourth retirement income strategy then. And this one is living off of dividends. Super popular one, particularly amongst Canadians who, as we know, love their dividends. How does this strategy work at a high level?
Yeah, it's again very simple, just exactly how it sounds. You're living off your dividends. It's a philosophy where you never touch your capital, only live off the income your investments produce, and just pick a bunch of dividends paying stocks, and you basically just live off that. And again, it is really appealing to a lot of people because, again, like I've mentioned, one of the biggest risks that anyone has or fears that people have is running out of money. They don't want to dig into their capital and run out of money. And this strategy feels really, really safe. People love the idea of living off the fruit of the trees without ever having to chop that tree down itself, right?
That's a really good analogy and definitely one that paints the picture. Can you maybe share an example of why living off dividends is such a popular retirement income strategy? Like, is this something that you see a lot of clients do and they really enjoy their experience?
Yeah, no, it is because, number one, like I said, it is quite psychologically comforting for the average person who does hate that idea of running out of money. And especially if you've got a large portfolios, dividends can be more than enough for most people. And dividend income is tax preferred in Canada, right? So Canadian dividends get a very, very favorable tax treatment versus interest income. So it is much better than getting regular income for a lot of people. So again, if you can create a portfolio that's, generating, again, back to that 4% rule, you're generating a dividend portfolio that's getting 5% dividends, and it might get even just a little bit of capital appreciation over the next few years. You essentially can pull out money, let's say, out $1 million, $50,000 a year, never ever run out of money, actually have more money to spend because, again, dividends are taxed at a much more preferential rate. And, it is something that is, from an average retiree's perspective, an easy strategy to implement. And for the most part, it is tried and tested over numbers of years as well.
Yeah, and certainly once that dividend snowball gets rolling, like you just get more and more money each year, provided that the companies that you invest in continue to raise those dividends, pay those dividends. It can be almost a little bit intoxicating, frankly, to see your portfolio continue to rise in retirement when people are thinking, my portfolio is going to be drawn down here. That said, all this stuff sounds great, Simon. There's got to be a flip side to this. So what are some of the potential risks with living off dividends that investors need to consider?
Yeah, exactly. There are risks to this. And you know what? Typically, most companies that do pay dividends are usually more blue chip stock companies that are generating enough profits to pay out those dividends. But that being said, dividend yields aren't guaranteed. Companies can cut dividends in recessions. Sometimes chasing high yields often means buying a riskier, unstable investments. I'll give you the example. I've had clients come to me and they're like, oh, I saw these 5 companies that have dividend yields of 8, 9%. And then you do a quick look at the companies and you're like, did you realize these companies also have lost, 20, 30% of value of their stock price over the last few years? So just the yield itself is not, indicative of how well the company is doing in itself. And at the end of the day, you know what? I always come back to this. Everyone's different, maybe that dividend yield at 4 to 5%, it just might not actually be generating enough income to support a comfortable lifestyle that the client wants, especially if they, maybe they've got they're a little bit older when they went into retirement, or maybe they don't have anyone to leave money to, and they have higher expenses. That yield just might not be enough to essentially live your best life. And again, it goes back to, you don't want to sacrifice your lifestyle and your overall happiness in retirement just to stick to a rule, essentially.
Yeah, and certainly I think the perception among some investors, at least, is that, particularly with blue chip dividend paying stocks, that these things are rock solid and the cuts don't happen. But if a dividend cut does happen, that's a really big hit to your income. If you're only living off dividends, you're not selling anything, right? That's a big thing to consider here. I want to throw something at you here because we have a recurring guest on our program. He's a dividend growth investor. His name is Henry Ma, great guy. He's made the case that investors living off dividends don't actually need to care much about things like the stock price of the stocks that they hold, or other external factors like tariff wars and inflation. Let's hear his rationale.
They're concerned about rising prices. They're concerned about inflation. They're concerned about tariffs. But all of those external factors really don't come into play for an income growth investors, because you're not dependent on the stock market for your income. You're dependent upon the companies. And if you identify quality companies that have paid and raised their dividend for a large number of years, that income they pay really doesn't come from the stock market. And certainly they could be affected by rising costs or tariffs, but I think you'll find that they're short-term concerns. They'll overcome those minor things, and very likely quality companies won't cut their dividends.
So, Simon, Henry's making the case here that, look, if you're really selective with the dividend stocks that you choose, they're tried and true for a long period of time, you're effectively taking a lot of that risk of a dividend cut out of the equation here, and you can pretty much just kick back and relax in retirement. What do you think about what he's saying there?
Yeah, no, I do agree with him in the sense that, if you don't need to live off the capital, you are just living off the dividends, and you are able to pick the right companies that continue to have a consistent dividend payout and do not cut their dividends, then yes, even if your stock portfolio dropped from $1 million to 800,000 and you still continue getting a $50,000 a year dividend payout, then that's not really a big issue for the most average retirees, because they're just living off that income. But again, it goes back to now you have to pick the right dividends, right, and have the right professional help essentially with that. And there are, again, a lot of especially from my business and the clients that we deal with, we do see a lot of DIY investors out there. And sometimes the metrics that they use to pick the dividend paying stocks are probably not ones that a professional would use, let's just say.
Yeah, sometimes the temptation is just to latch onto the yield because it looks really attractive. But there's more to the story there to consider for sure. So what do you think that an investor could do to help address some of those potential risks if they decide to live off dividends?
Yeah, I'm a big believer in hiring professional help and using people that are specialists in their fields. And typically, this is when you're going into retirement, you really only have one shot at it. You kind of can't mess it up. I know that a lot of times, especially us being constantly on the internet, we always see people always talking about fees. But at the end of the day, I do think that for a lot of retirees, they don't have the time, they don't have the energy, and they don't have the skill sets to manage probably, a proper dividend-paying portfolio. And sometimes it does make sense to hire a professional to manage that side of the world for you. So, A, you don't have to stress about it. B, also when the markets drop, you have someone to talk to so that you can understand what they're actually doing. And I think at the end of the day, I think that is definitely, that peace of mind, that ability to, wake up next year and know that, you've got a professional keeping an eye on your dividend portfolio. You're going to get the amount of money you need to survive off of. I think that is definitely worth the fee that you would pay any kind of portfolio manager or fund manager to do that for you.
Yeah, that's certainly one way to go, particularly if you don't really want to be bothered or you don't feel like you have the head to manage all that stuff. If you do it DIY style, then of course keeping your portfolio manageable in its size can also be one thing. I know Henry, as an example, is a fan of keeping that to 10, 12 stocks, something like that, of really high conviction plays. Sure, that comes a little bit of a diversification risk too, but it does make it more manageable. So that may be something to consider as well. Let's get to our fifth and final retirement income strategy here, and that's infinite banking. This one created a lot of buzz online here. Walk us through how it works, because it is a little bit complicated.
Yeah, we've definitely seen a lot of popularity with this strategy online. We get asked a lot of it whenever we meet higher net worth clients. It's also called Be Your Own Banker. There's a very catchy marketing around it, and but at the very core basic level, it uses a participating whole life insurance policy where you overfund the policy and the premiums build up a cash value, and then you could borrow against that cash value to fund your retirement. To basically invest that money, make business purchases, and do a bunch of other things with that money while the policy still continues to grow on the cash side, and there's still a large death benefit for it. So It is a very popular strategy because it does combine insurance with that tax sheltered growth, and it really appeals to those who don't necessarily like, let's say, dealing with institutions, and they want control over their borrowing. So.
Yeah, I mean, when you have a title like Infinite in there, it definitely, piques eyebrows and makes people, want to turn their heads and see what it's all about here. That said, again, there's complication here. I'm seeing that there's leverage involved, which we talked about a little bit earlier here. What do you think are some of the risks that somebody doing infinite banking here would want to consider? And perhaps is there a horror story that you can share that kind of illustrates some of those dangers?
Yeah, it's number one of the biggest drawbacks, it is quite expensive to fund. I think average person should not be entering into this strategy. For the most part, if you're going to invest in whole life, unless you've got most of your tax sheltered investments like RSP, TFSAs maxed out, from just an investment efficiency standpoint, it may not make sense to get into this. It's also very slow sometimes to build liquidity. Sometimes it takes a few years before the cash value is actually at a meaningful level, especially if you're not overfunding the policy by as much. And unfortunately, one of the biggest drawbacks is I think it's really misunderstood and oversold by some advisors. So clients over assume the benefits of it. So I don't even know where to start on some of these horror stories I've heard, but I can start with one that I've recently heard from. We met a business owner who essentially, a few years ago had been pitched this infinite banking at a seminar. To him, he told us it was framed as a can't lose strategy. He'd pay into this whole life insurance policy, build up tax-free wealth, and be able to borrow against it for business opportunities and retirement in the future. And it also invest some of the money. So, he signed up actually for a very large policy, almost $150,000 a year in premiums. That's not unusual for a higher net worth client. That you do usually need those bigger ones for the banks to borrow money. But again, he wasn't fully prepared for the amount of commitment that was required to keep this policy going. For about 2 years, he made some premiums. He sunk about $300,000 into it. But in those 2-year period, his business had changed a little bit. And the cash flow that he had going to his business wasn't quite where it used to be in the prior 2 years. And by the time he came to us, he realized he couldn't keep up with the huge premiums. He asked about exit strategy to the person that had sold it, only to discover the problem is that in the early years of this whole life policy, a lot of the money went to actually just the cost of insurance, and he hadn't actually accumulated much actual cash value in it. And he just said, my life's changed, my business changed. I really have to surrender this policy because I do need the cash right now. And unfortunately, the cash value was quite a bit lower than what he had initially put in. So he basically walked away losing about $125,000 on this policy. He just didn't make a ton, or there was just wasn't enough cash to cover off what he had put in. But it didn't stop there, because he also had leveraged some of this money into an investment, and to cash out the policy, he also had to pay off that part of the loan. And the markets at the time had turned as well. And in addition to that loss on the life insurance policy, he also lost $15,000 on the investment. So, I mean, the lesson is that infinite banking requires long-term commitment and a clear understanding of how both the insurance contract works and how leverage works, and even how the risks are involved for them as a client. And it could be powerful sometimes in the right situation, but it's not a can't lose play where it leads to where it can lead to massive financial gains, because as we've seen in this case, it can go the other way as well for some clients.
Yeah, it sounds like a strategy. I feel for that client, by the way. That's rough. Sounds like a strategy like when things are going well, it's going really well, but when it's not going so well, it's really not going well. And, again, maybe something not all retirees want to have in the back of their mind there to worry about. Simon, really appreciate you walking us through these 5 retirement income strategies here. We have come in us hot and fast here. We got tons of questions. So why don't we open the floor to our audience and see what kind of questions they have for you here about retirement income strategies. Let's see what we have on tap here. I see there's a question from Kenneth, that's coming in. In general, is it not best to draw down RRIFs first and TFSA second? What do you think about that, Simon? Is that generally a best practice?
Yeah, again, generally it does make sense. Obviously, especially if you've got some big estate planning goals, you're trying to avoid that big deemed disposition upon passing. Also, once you turn 71, you're forced to convert to RIF, obviously, and you're forced to do a specific withdrawal. But I wouldn't say it's for all cases. Again, it may depend on person to person. And especially if you already in the first few years, let's say you retire early in your 60s, and like I said, you've got some big drawdowns that you need because you're taking big vacations. Potentially you're doing home rentals, you're doing all those goals that you really wanted to do. From a tax efficiency standpoint, sometimes it may make sense to do a combination of a RSP, RIF withdrawal with TFSA to kind of keep you under a specific marginal tax rate as well. But typically, it does make sense from a rule of thumb point of view. Yes.
Yeah, certainly. I know a lot of people, really top of mind is tax for them in retirement. And I think that a lot of people like the idea of just getting that tax liability out of the way and leaving the TFSA to grow so much more because then when you need it, perhaps you have expensive medical bills down the line in your older retirement ages, you have that tax-free money to pull from, and hopefully it will have grown for a long time. So definitely something to consider. Thanks for sharing your opinion on that one. Patrick has a question for us here. Let's see what Patrick wants to know. Are many of your clients switching to all-in-one ETF portfolios for their tax efficiency, effectiveness, and low cost? What are you seeing, Simon?
Yeah, especially in our practice, we are fee-for-service planners, so typically we get a lot of clients that are clients that like buying ETFs or buying, like in this case, all-in-one ETFs. Yeah, we definitely see more and more clients moving towards that direction, especially in the younger generation. Because again, it's simple. ETFs are quite efficient nowadays, and with people's comfort with technology and the amount of technology when it comes to being able to buy investments online. It's just become a lot easier for average person to manage their investments online.
Yeah, it certainly takes some of the tedium out of rebalancing and remembering to rebalance when, in your golden years, you probably want to do a bunch of other fun stuff, not sit in front of your computer and manage your portfolio. So I can certainly see the appeal. So something for folks to consider here. Sharon has a question for us. Let's get to what Sharon wants to know. She's saying when a DIY investor is relying at least 50% of their dividends from an RSP for retirement income, when does he stop dripping in order to accumulate cash? That's an interesting question there, Sharon. Simon, do you have any best practices around when to turn off drip?
Yeah, no, that's an interesting question. Again, I would say it's really going to depend on situation to situation, right? I keep going back to this, and I know I've mentioned it a bunch of times. It's really going to depend on your goals, depending on what you want to spend, what kind of lifestyle you want to spend in. And a lot of times, this is the one place where I would say, get a little bit of advice around that first before kind of determining the best course of action going forward on that. Because again, I'm a big believer in, you should be able to essentially do what you want to do in your retirement. And sometimes you don't want to follow these rule of thumb specifically, especially if it is going to hurt your lifestyle and happiness. So.
Yeah, I know one thing that some dividend investors who are retirees do is like if they have any leftover money that they're pretty confident they're going to have left over, then they'll kind of leave that little bit of the drip going, but then the rest of it they're just pulling out the income. But they like the idea of continuing to invest as much as they can and build in a little bit more of a safety net, I guess, throughout their retirement. So that's something to consider as well here. Jamil has a question for us. Let's see what Jamil's got for us. Is it better to take CPP and OAS early or delay until age 70? Classic question, and actually we're getting a lot more buzz about that recently. There's been interesting studies coming out that kind of challenge the traditional wisdom. Simon, share your wisdom with us. What do you think?
Yeah, no, that's a extremely common question we get again. Should I take it early or should I not take it, or should I wait? And for those of you that don't know, the later you delay your OAS CPP buy, the more CPP and OAS you get. So there's huge advantages to delaying it. But also, if you take the OAS CPP earlier, it also means that you are collecting the money much earlier in life. You can invest that money and get a rate of return. So it really, again, it's going to come down to a few things, right? Number one, it comes down to, do you need the money? Do you know, like if you're retiring at age 60, do you have more than enough investment income and investment portfolio to kind of bridge you to that point of, you know, if you were to delay it? Number two, what's your health like, right? Again, if you've got, a history in your family where there isn't longevity, and there is most people pass earlier in their 70s, or you already have health issues, sometimes again it makes sense to delay your or take the CPP OAS a little bit earlier, because then at least you get it, right? Because if you delay your OAS CPP to age 70 and you pass away to age 72, you're not really getting a huge benefit from that increased OAS CPP. And I would say for a lot of clients that do have, a good portfolio, a good amount of net worth to delay that OAS CPP, for what I find for the most part, because it is, pegged to inflation, delaying your OAS CPP does make a lot of sense for a lot of clients, well into their later 60s and 70s. So just we've ran numbers around it, and it does seem like that. There's the break. Usually, depending on the client, the break-even point is, as long as you think you're going to live past that, anywhere from age 67 to 69, depending on your situation, your OAS CPP. A lot of times it does make sense to delay it to age 70.
Yeah, interestingly, just to kind of dovetail on that thought, we had a retiree on our show a couple months back here, and he was talking about how his decision to delay CPP and OAS is actually going to let him spend more money today, earlier in his retirement, because he knows he has those, to your point, indexed inflation, increasing payments coming from CPP and OAS over time. So really interesting stuff if you can afford to bridge the gap, as you say. Simon, fantastic job fielding all these questions from our audience. Really appreciate you taking the time and sharing all those retirement income strategies with us. Unfortunately, time beats us here, and there's so much more that we could cover in retirement, but we'll have to have you back again soon to talk more about that. But really appreciate you taking the time to chat with us.
Yeah, thank you very much, Robert. Always appreciate you inviting me as well.
We'll have you back soon. And for those in our audience, of course, thank you for tuning in. Remember, next week is the kickoff of Investor Education Month on Inside Investing, as well as at TD Direct Investing. We're going to have a panel of financial influencers joining us to share their top investing tips for newbies and the lessons that they learned in each of their unique investing journeys. They all have different investing styles, and they're going to share all the takeaways from that. There's going to be lots of laughs, lots of learning. You don't want to miss it, okay? That's all the time, again, that we have for today's show. From everyone at Inside Investing, thank you so much for tuning in. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.